Very good evening, members. On behalf of the Managing Committee of the Coimbatore branch of SARC of ICAI, I welcome the Speaker of the Day, CA V Ramnath sir, who has been always a supportive hand to the branch in all the programs and as a guide to our for the Direct Tax Committee of the branch. So I really thank you, sir, for accepting our invitation and coming down here. Thank you very much, sir. We welcome you again. I also welcome each and every one of you for your participation. I welcome you all. So today we are starting the refresher course of 4 days refresher course on direct taxes with the topics on class by class analysis of Finance Act. Is it audible? Class by class analysis of Finance Act 2018 by CA V Ramnath sir. And tomorrow we will be having HUF, AOP and firms, assessments, updates and recent issues by Dr. C.A. E. Palgan Kumar, past chairman SARC from Tirupati. And on Friday, 11th of May, we will be having income tax returns for the assessment year 2018 and 19, recent changes by C.A. M.S. Nagaraj from Coimbatore. And on 12th of May, we will be having a session on capital gains, recent updates and issues by C.A. S. Ramachandran, past chairman from Coimbatore. The speaker of today's session, C.A. V. Ramnath sir. C.A. V. Ramnath is a commerce graduate and a chartered accountant in practice for more than 2 decades. He is a rank holder in CA Intermediate, CA Final and Gold Medalist. He specializes in direct taxes, audit of charitable trusts and societies, corporate audit and taxation, and representation before appellate authorities. He is a regular speaker at regional and national level and a renowned faculty for CA Final Direct Taxes at Coimbatore branch. With these few words, I am very happy to introduce the speaker of the day, CA V Ramnath sir. So, with these few words, I welcome you all again and I hand over the dais to the speaker. Thank you.
Mr. Rajesh, Chairman of Coimbatore branch of SARC of ICAI, and his dedicated team of office bearers, senior members of the profession, fellow members. It's immense pleasure for me to stand before you this evening to discuss the topic assigned, namely class by class analysis of the proposals in the Finance Bill which became Finance Act. On 29th of March 2018, the President gave the assent to the Finance Bill and thereby it has become Finance Act. Of course, we all expected that this budget would be, 2018 budget would be at least very friendly one. So much of SOPs would be given, but of course being last year of this particular government for this term. But quite strangely, not audible. But quite strangely, nothing much was as a given to the middlemen or common people, etc. I was just recalling this with Manmohan Singh's last budget when Narasimha Rao was the Prime Minister, and every year he used to say that we have to tighten the belt. Every year during the 5 years term he used to say we will have to tighten the belt. By which time Pranab Mukherjee, then Planning Commission Chairman, said we have to tighten whose belt, was the language with which he was replying. And every year people used to really get afraid of what is going to be in the finance bill proposal of Manmohan Singh, and the 5th year Congress budget of PV Narasimha Rao government. It was really a very interesting one. People felt nothing much was given, at least nothing damage has taken place. To that extent people felt it was okay. Here again the same feeling, even if they are not going to give any SOP for us, if they don't damage further, it is more than sufficient. This is the feeling with which this particular budget was expected. But quite people have been very expecting that at least some common man will get some benefit, etc. But nothing much has happened. Be that as it may, at least from the professional front, whether the complications have taken place, how the days to come it is going to take up is something which we will have to debate, because in the recent past we can see that the human interface between the SSC council department is getting reduced. We have to communicate only through emails and correspondence only through machines, whereby unless we take note of these changes very seriously, there would be unintended hardship to the SSC. Suddenly you will get one notice or one intimation from the CPC where at least 3 times of your turnover will be the tax payable. How they are working out that is a question mark, and we will have to run pillar to post to see that it is reduced. And gone are those days where a council could say, I'll file an appeal, don't worry. Because if at all we say today we'll file an appeal, on the demand 20% will have to pay first. And after filing appeal, for maintaining the stay, you will have to pay 20%. That's a really costly affair as of today. And therefore, now we'll have to be a little more careful in following up these changes and see that while filing the return of income itself, we'll have to take that precautions, failing which definitely the machine generated intimations are creating nuisance day after day. And one is the intimation for which we have to respond, another one is this arrear. Though we have already settled all those cases, again and again we will have to write letters and communications to see that this is getting brought to zero or this is getting zero. So therefore, the changes which have taken place in the recent past need to be taken into account seriously, whereby we will not put the SSC into unintended hardship. With that prelude in mind, we will now step into the proposals made by the Finance Bill in 2018, which has been converted into Finance Act. The interesting part is, nowadays from Finance Bill to Finance Act there is a change. Earlier at least Finance Bill will get through, but nowadays from the Finance Bill to Finance Act also there are changes. Normally we discuss more and more on Finance Bill and that gets recorded in our mind. Afterwards, fine line differences between Finance Bill and Finance Act we don't attend to, and we believe what we have understood is correct. Sometimes subsequently when we listen to or when we go to a particular text, it is surprising for us to see that there is some more changes. Therefore, it's ideal to listen to or the changes made in the Finance Act so that it will help us to appreciate the law properly. Keeping this prelude in mind, let us get into the topic proper. There is wide range of expectation that the rate of tax will get altered, at least slab rate will get increased, etc. But nothing tangibly has happened. All the SSCs will continue to have the same rate of tax as in the past, as in the last year, excepting for a corporate entity. And Mr. Palkiwala used to say those days, people in the North Block of New Delhi always have one feeling. Every change is meant for progress. That's the feeling they've got. Every change meant for progress. His language is very interesting. People in the North Block of New Delhi eternally mistake amendment for improvement changes for progress. Eternally they mistake this. We have education chess, then we had secondary education chess, now health and education chess, increasing 3% to 4%. If you retain education chess and make it 4%, so we'll pay 4%. No change in it. But changing it and then increasing slightly. So whereby the change will only be looked into, the percentage which we increase will not get attended and will anyway pay out of our pocket this money. So now health and education chess is the new avatar of what we had earlier. So the software companies have to accommodate this in the bill, finance, invoices, etc. and they will have good business. So otherwise than that, what purpose it would serve is a great question mark. So health and education chess is the new avatar. Rate is getting increased from 3% to 4%. For a corporate SSC, of course, good relief to say. And it says where the turnover in the financial year 16-17 does not exceed 250 crore, for the financial year 18-19, the rate of tax is going to be 25%. We can see this change for the last 3 years. When financial year 16-17, the government said, where the financial year 14-15 turnover does not exceed 5 crore, the rate of tax is going to be 25%. A care has to be seen in this particular case. For the financial year 16-17, February 16 is the finance bill which came in. They said for financial year 14-15, 16-17 rate is decided. February 16 is what the time they are announcing this rate, but they are taking 14-15 as the base for deciding the rate. Similarly, for financial year 17-18, February 17 is the time by which this announcement comes for deciding the rate of tax for a company. The turnover of the preceding fiscal is what is contemplated, not the year in which that announcement comes 1 year earlier, whereby at least return would have been filed by a company. There is no scope for February and March month adjusting turnover to reduce to certain level, etc. They have to stick on to the previous year fiscal. Similarly, for the financial year 18-19, in the financial year 16-17, if the turnover does not exceed 250 crore, then the rate of tax is going to be 25%. By and large, all SMC companies, by and large majority of the companies will come under this category. So the rate of tax from 30% has gone down to 25%. But in the financial year 2 years before, one new section came, 115BA. That said, you don't opt for any benefit, we will ask you to pay only 25%. A company started on or after 1st of March 16 and not opting for any incentive provisions, 25% will be the tax rate. Now even other companies, after claiming all the benefit, also will get 25% now. So if somebody has opted 2 years before for this new provision, he is a foolish personality. All the 250 crores less turnover companies will anyway get 25% after claiming accelerated depreciation, after claiming unabsorbed depreciation, if any, after claiming chapter 6A deduction, still they will get 25%. If somebody has already opted for it in last but 1 year, then without claiming all these things, he has to pay 25%. But now, even otherwise they will get 25%. That's where one is not supposed to be over enthusiastically tax planning in this country. Otherwise also one day it will come to us. If at all we are over enthusiastically planning, then necessarily we will lose. In the year in which these budget proposals came, I was listening to one of the speakers in Bombay. They said all the existing companies, let us amalgamate with a new company. We'll float a new company after 1st of March. Amalgamate this with a new company, all these existing companies with a new company, that becomes new company 25%. 100 crores, 200 crores tax paying company, 5% saving is sizable. You can go to High Court of Bombay and get the amalgamation done. If at all of them have done it, at the end of the day, what is that they are going to lose? Unabsorbed depreciation, accelerated depreciation, chapter 6A benefit, everything they will lose, and then they will get only 25%. 2 years down the line, we are also going to get the same thing. So why we should enthusiastically do all these things and get caught is something which we'll have to be careful about. Otherwise, adventurous tax planning may cost like this, because down the line, everybody will get the same aspect. This is one classic example. Now, 115BA came out with one interesting proposition, but of course it has got very little life because other people also are going to get the same number. What did it say? The company should have been started after 1st of March 16. The first year, assessment year 17-18 onwards, they will get this benefit. Loss, if any, should not be set off in the subsequent year. No accelerated depreciation should be claimed. Incentive provision under chapter 6A should not be asked for. In that case, excepting 111A and 112, short-term capital gain arising from transfer of security suffering STT or long-term capital gain, excepting those cases, all other income of that particular company will be chargeable at a flat rate of 25%. All other income of the company will be chargeable at a flat rate of 25%. Short-term capital gain 15%, long-term 20%. Barring that, all other will be 25% is what the provision came. Government started realizing the tax planning idea of the SSEs only little later. It says, except 111A, 112, all other income of the particular company will be chargeable at 25%. Now, assuming for a moment a company has introduced share application money in the name of fictitious people in the very first year of operation, it is picked up for scrutiny, verification takes place. After all that, now that share application money which is proved as not genuine, liable to be taxed under section 68, and 68 will trigger 115 BBE. 115 BBE 1 year before demonetization asked for 30%. During demonetization, the rate has got escalated to 77.25% with a penalty of 6% where there is no surge. Otherwise, 6 will get replaced by 60, 137.25%. Now, if a company has given bogus credit, has received a bogus credit, unable to prove its creditworthiness of the parties, now this company which is opting under 115 BA would say, excepting 111A and 112, all other income of the company shall be chargeable to tax 25%. Even this section 68 addition should be chargeable only at 25%, which was an unintended benefit given in the section, which was not intended at all. To overcome that, a retrospective amendment comes now. Instead of section 111A and 112, it is now getting replaced by any income under this chapter, respective rate. All other income other than income covered under this chapter will be at 25%. So if 115 BBA comes, 115 BBE rate only will be applicable. So the idea of this amendment is only to see that any other income covered by special provisions should be taxable only at that rate, and normal income will be chargeable at 25% as against 30% which is available to the corporate. In case they are opting for this, where accelerated depreciation should not be claimed, chapter 6A incentive should not be claimed, set off of losses should not be asked for. But again, as we have seen in the earlier slide, whether at all this is a worth case is something to be examined, because up to 250 crores turnover, the rate of tax is going to be 25% even after claiming all these benefits, and therefore one can think about whether at all one should come under this particular provision. The next provision relating to rate of tax could be something which is unintended, sought to be addressed or retrospectively amended. 115 BBE originally said, when originally 115 BBE came, it said 115 BBE subsection 1 class A. Class A said income covered under 68 to 69D chargeable at 30%. Class B, all other income at normal rate. When demonetization took place, people said, anyway, I'll offer as current year income 30% finished. What's the problem in that? So government felt people will offer current year income and pay advance tax. What's the point in it? And therefore, they made Taxation Laws Amendment Act that old Class A and Class B got replaced because of this Taxation Laws Amendment Act, where it said Class A voluntarily declared 68 to 69D. Class B, assessing officer identified Class A to 68 to 69. So both of them will be chargeable at 66. 30 has increased to 60 with 15% surcharge, 75, and 3% education says 77.25%. Where such doesn't take place. Such takes place, the penalty will be 271 AAB instead of 271 AAC, 6% will become 60%. But subsection 2 of 115 BBE originally said no deduction of an expenditure or losses or an allowance can be claimed against Class A of subsection 1. Originally Class A said 68 to 69D, Class B all other income. So against this income 68 to 69D, no deduction will be allowed for an expenditure or an allowance or set off of losses. Now Class A talks about voluntarily declared 68 to 69D. Class B talks about assessing officer identified 68 to 69D. But the restriction of set off of losses, deduction of an expenditure or allowance was confined only to Class A. That means assessee voluntarily declaring. If the assessing officer identifies it and the assessee has a brought forward loss or a current year loss or an allowance, nothing prohibits for that to be set off. This was unintended. Last year itself it was brought to the knowledge of the Finance Ministry, but no amendment took place in Finance Act 2017. But the Finance Act 2018 retrospectively amends from 17. So both Class A and Class B of subsection 1, against that, no deduction towards an expenditure or an allowance or a set off of loss permissible. So 68 to 69D either it is identified by the assessing officer or voluntarily declared by the SSE, losses set off not permissible, any expenditure against that is not permissible, allowances against that not permissible. The latest current year business laws also not allowable. Last but 1 year amendment came. Earlier brought forward loss was only a subject matter of discussion under 115 BBE subsection 2. Last but 1 year the amendment came. Current year set off of loss also prohibited.
Set off is not current year loss. Current year loss is current year loss.
Set off is the current year loss. Brought forward is only what is sought to be addressed. So now 115 BBE got amended by Finance Act 2016 to incorporate current year loss also. So whereby the set off of losses and the allowances deduction towards expenditure is ruled out. So now anything addressed under 68 to 69D either voluntarily declared by SC or determined by the assessing officer will be open for the rate prescribed under section 115 BBE subsection 1. So this is an amendment which has been retrospectively made to set right something which was omitted to be done in the year in which the original amendment came to increase the rate of tax for the income covered under section 68 to 69D. Now, a matter of concern. Normally in our practical life, when an assessment proceeding started, we'll get very interesting surprises from the assessee side when the assessing officer communicates. I had one very practical scenario where a junior member said, "Sir, it is something difficult for me, can you please help me out in a particular assessment?" He said, "Why not? That officer is somewhat known to me, I will say that you are an early stage practitioner, no problem, let us go." So I took him, I said to the officer, he's in the early days of practice, please help him out, it's a very early days for him, don't unnecessarily strain too much. Officer said, "I'll do, no problem, I have an information which says this assessee has got a bank account in which he has deposited more than 10 lakh rupees. Ask him to give that bank account, I will reconcile and I will finish it off." The junior went and asked the assessee, as he gave one bank statement, he came and gave it to the officer. Officer just saw the bank name, he opened his drawer, saw the paper and closed it, said, "This is not what I wanted. Something else is there, go and ask him." But he did not give the paper back, he kept it in the file. In addition, he said, "Something else is there, go and ask him." The counsel went again, asked the assessee. As he said, "No, I don't have anything." He said, "No, he has got some information, check up." Then it took a week's time and then came back and said, "Yes sir, one more bank account. My son was maintaining it in my name, which was not known to me. So this is something you can consider." So that bank statement went to the income tax department and officer saw and opened his drawer and closed it. "This is not the one I wanted. Something else." Then this officer got into some sort of discomfort position. We have been attempting to help this young boy, but something wrong is happening. Went. Third, as he said, "Nothing doing, sir. No such. 2 years back, nothing." Now, he has already got the information, careful. Even 1 week later he said, "Yeah, my wife is maintaining one account in my name, which she never said. It's a therefore habit." He went and showed. That day I was unfortunately inside the chamber of the assessing officer. He opened the drawer and saw, "This is the last occasion. This is not the bank account. Only one more. Carefully do it." I just asked, "What is happening?" "See this, sir. I have got one information that he has got a bank account in which he has deposited more than 10 lakhs. I have been saying this fellow, he has been coming from the SSC with one piece of paper where this is not matching. This is the last occasion. Hereinafter don't expect me to be very comfortable. Definitely I will take action." He went and said, as he refused. Afterwards, 1 week later, he said, "My brother-in-law is maintaining one bank account, operating my bank account, so this is my bank account." Then he went and showed, officer saw, yes, perfectly all right. The first one has got 11 lakh deposit. The second one has got 22 lakh deposit. The third one has got 33 lakhs deposit. The fourth one has got 44 lakh deposit. The assessee was choosy. We'll give 11 lakh deposit account. If it matches, we'll forget the remaining. If not, increase the risk, 22 lakhs. If not, 33. Finally, 44. Unfortunately, 44 was listed in the income tax department's records. Now, in the process from 44, 11, 22, 33, 44, everything was cut. Now what happens? Now you will have to show this as income as undisclosed investment under 69. Bank deposits are made. Similar scenarios you will find as to money lost by SSE in the derivatives or share markets, etc. To be honest, to share with, in my limited experience of 22 plus years of practice, not even one single return with profit I have filed for derivative market cases. Everybody would be only giving a loss return. Still they are very confident they will make profit in future. Which day that future will come, we do not know. But they are all very hopeful. We are also hopeful to file return for them. So now some of the cases they will not even report all these things. With normal transaction will file. In a scrutiny these things will come up. A bank account with 20 lakhs, 12 lakhs, 11 lakhs. Where has the money gone? To derivative market. What has happened finally? Lost. Now you prepare, there is a loss one side. For which money has come? That money has come from undisclosed sources. Now you would like to say, okay, I will offer this as income from other sources. This loss and this both are in the current year. I will offset both. I have already lost the money. There is nothing I want. We will set off both. The loss, derivative loss 110 lakhs. Also undisclosed income of 110 lakhs deposited in the bank account. Both will offset. Thereby there is no income for the SSE. Let the assessment be completed. But the problem after introduction of 115 BB is, this amount will be regarded as income covered under section 68 to 69. Against which set off of losses, brought forward losses, or claiming of expenditure, difficult. So this gets taxed at a higher rate, and the officer will say, if you have filed the return within due date, this loss you can carry forward. In which day he is going to claim 110 lakh rupees income to carry forward and set off this particular income is a great question mark. Now this is what is going to be a troublesome affair after this particular change has taken place, number one. And the latest Ahmedabad Tribunal judgment clearly says, if the SSE comes up with the proposition that this is something which was not originally in the return of income, but only when the scrutiny started he says, I have lost some money in this particular deal, and I have got income from some areas where I am not in a position to disclose who has given me the money, and this amount will offset or we don't offset, that's a different subject, but the entire information comes up only during the course of hearing. Therefore, this particular case is fit for levy of penalty. In addition to paying tax at the special rate for the undisclosed income, the SSE would be exposed to pay penalty for not furnishing the information correctly in the return of income. So this particular proposition, latest Ahmedabad Tribunal judgment, categorically says it's a very fit case for levy of penalty also. Because there is a case of furnishing inaccurate particulars of income in the return of income. So therefore, 68 to 69D cases would definitely expose the SSE into trouble in case it is not properly disclosed while filing the return of income. Therefore, educating the SSE is an important subject in the days to come. Gone are those days where it can be mentioned that whenever the officer identifies, let me pay the tax. Today also I have to pay tax. Even if he identifies also I am going to pay tax. It's a matter of interest. I'll enjoy the money, I'll earn income out of that, I'll pay the interest what the government asks for. Gone are those days. The tax rate coupled with interest and penalty are going to be costlier than what otherwise the SC would earn by retaining this money. So one has to really educate the SC that taking that risk is at its own cost. Corporate SC or non-corporate SC, at his own cost, the SC takes this risk, and council should not go to the extent of advising that if at all they identify, let us pay tax, till such time we enjoy. Because a small aspect we can share with. A survey takes place where a stock is identified is more than what is again available. Stock is considered as what is more than available in the books. And SSE says, yes, I have got more stock than what is actually available in the records. I am ready to pay tax. Now under what section actually it is going to cover? 69 or 69A or 69B or 69C? Another controversy. Now the incremental income will be chargeable at special rate. At what rate now? 60% plus 15% plus 3%. Next year onwards 4%. Now the department goes one step further to say you have purchased first this inventory and you are yet to sell, meanwhile we got you caught. That means it is unexplained expenditure, not unexplained investment. So we will rope in under 69C. Once you bring it under 69C, the next problem would be, there is a proviso below 69C which says this amount will not qualify for a deduction under any other provision in any of the years. Subsequently, if the stock is sold, this cannot be deducted. Madras Tribunal endorses this view. So physical stock 1 crore 20 lakhs, book stock 80 lakhs, 40 lakhs agreed to be offered. For 40 lakhs, 83.25% agreed to be paid. Now this 40 lakh is sold for 45 lakh. This 40 lakh will not qualify. In the year of sale, for 45 lakh, normal income you have to pay. Illogical. But logic and income tax may not go in hand always. Madras Tribunal endorses this view. It is amounting to 69C. So, if a person says, this year I will not pay advance tax, let us reduce the stock and finalize the accounts. Gone are those days where we can say, unless they come for a survey, it is difficult to identify. Even if they come on that year, we will pay tax along with interest. The days to come, this is going to be a costly affair. So, therefore, we will have to appraise the SSE. If he is mentally ready to pay 83 as well as 100, instead of paying 30%, 183% he will have to pay. That is going to be the way in which the law gets interpreted in the recent days, where the SSE attempts to reduce his income. So that particular matter is something which we need to necessarily educate the SSE. So as in the past, if the SSE continues to say, I will plan to reduce the inventory, etc., to pay lesser tax, that is going to be a costly affair for the SSE in the days to come. Then the other two relating to rates are not very great amendments. 1012A was talking about NPS withdrawal. Originally it was available to the employees only. Therefore the word employee was there in the statute. Subsequently it has been endorsed, not only for employees, also for professionals, self-employed people. Therefore the word employee is getting replaced by SSE. Nothing great about it. If you close that, if at all you make a partial withdrawal, 1012B talks about 25% exemption. That again, both for SSE employee and non-employees allowed. The next important proposition, which is really going to have very interesting dimensions, is 222. 222 talks about dividend. And in addition to normal 222A, we have so many legally framed dividend which was not originally considered as dividend for corporate law purposes. The last being 222E, most controversial provision. When 115O came into the statute, the law said 115O shifts the burden of paying tax on the dividend from the shareholder to the corporate, but this 115O would not apply to 222E alone. So 115O will be applicable for 222A to D. It will not apply to 222E. In many of the occasions, whether 222E gets attracted itself is only known when we finalize the accounts. Till such time things will keep flowing. So they will take money and thereafter they will withdraw, repay, etc. And after finalization, we will have to break our head as to how to overcome this. And all the more, company law also adds giving loan to director, etc., 185, 186, and giving that for those cases audit report is a nightmarish exercise for the council. But as he will continue to be as in the past, he will not worry about it. According to his own company. So whenever he wants, he will draw money, whenever he wants, he will reinvest the money, and we will have to break our head for it. Now, the law says we will shift the burden of paying tax on this 222E from the individual SSE to the corporate. Earlier, for 222A to D alone, it got shifted. But now 222E, class E also gets shifted from individual to corporate. Now, what is the rate of tax? For 222A to D, the rate of tax is 15%. It gets grossed up, further increased by surcharge and education cess. So, though it is 15%, the effective rate is 20.56%. Corporate dividend tax, effective rate is 20.56%. For 222E alone, Instead of 15%, it is 30%. And no grossing up. Surcharge and education cess will continue. If that being the scenario, it will be 34.944% effective rate for this 222E coming under 115O. So for 222E coming under 115O, the effective rate of tax is 34.944%. Though it is 30%, thank God grossing up is not there, surcharge and education cess will come. Originally the individuals, the shareholders were paying dividend tax, and some of them will be paying a 10% bracket, some of them 20%, some of them 30%. And those days, government said collecting tax from all of them is very difficult task, some of them are not reporting at all. Therefore, we will shift it to company, flat 10% we collect, average, some of them 0, some of them 30, some of them 20, some of them 10, at least 10%, fine. Then they kept on increasing the rate, 10 became 12.5 became 15, thereafter added surcharge and education cess and new concept. If at all the recipient has paid, he would have paid and he would have received 100 from company, paid 15, 85 would have retained. Company gives him 100, also pays to government 15. So the amount what is given to him, 15 by 85, not 15 by 100. That's how you have to ascertain the rate. So government started tinkering amendments whereby the effective rate from 15 has gone to 20. Still government was not very happy. In one of the occasions I was discussing with then CIT appeal, he said, Asim Premji gets how much dividend, you know? Company is paying only 12.5%. Had it been taxed in his personal status, 30% he would have paid. Government is losing too much. See, already on the income earned by Wipro, government has collected tax. On the income Wipro earned, Wipro paid tax, and then it pays dividend to the shareholder, it's a double taxation. Now, the CIT appeal says, Wipro chairman is only paying, he is not paying anything, company pays only 12.5% DDT. Had it been taxed in his personal status, we would have got something more. This idea of the CIT appeal somehow got translated in the income tax, CBDT, Mindset and Tax Policy Division. They came out with 115 BBDA. If more than 10 lakh rupees is received as a dividend, let the company pay 20%, let the individual also pay 10 more percent. So now this triple taxation. Company paying tax on income and thereafter it is paying tax on its dividend and the recipient paying tax on the dividend. If the dividend so received in a year crosses 10 lakh rupees, he has to pay another 10% basic rate plus surcharge and education, this depending on the slab in which that surcharge falls. So anyway, company will pay 20, individual will pay 10. 222E also same, 30% company will pay plus surcharge and education says 34.944%. So effectively it will become one and the same. But the danger in 222E is, one way it is a welcoming proposition. In the earlier provision, 222E, the danger is all that triggers based on the accumulated profit available in the balance sheet of the company. If the company has accumulated profits and the amount is given by way of advance or loan to a shareholder having more than 10% beneficial shareholding in the company, to the extent of accumulated profits, it will be treated as dividend and he has to pay tax. See, the danger here is, assuming February 1st, one shareholder having 12.5% share holding in the company receives 10 lakh rupees. The company has 50 lakh rupees dividend, accumulated profits. This 10 lakh will be treated as dividend. Prior to this amendment, it will be taxable in his personal status as income. Now, February 1st, he received 10 lakh rupees. And February 15th, he repaid this 10 lakh rupees to the company. February 16th, another shareholder having 12% shareholding received the very same 10 lakh rupees. The other shareholder we have to expose for 10 lakh rupees. He cannot say already Mr. A has paid 10 lakh rupees tax, on 10 lakh tax, therefore I will not pay. Accumulated profits are available for 50 lakh. First 10 lakh only has gone to A. So the same currency may come again to company may give to other shareholder who has got more than 10%, again another 10 lakh rupees that person has to pay. Now he has repaid. Subsequently, company wanted to declare dividend. Suppose he is not repaying, he is holding it as it is. Company declares dividend and the receivable from him is sought to be set off against the dividend payable to him so that we will set right the accounts. But what happens now? Because you declare dividend, company has to pay DDT. The amount what he has already paid as a tax in his personal status cannot be offset. Prior to this amendment, Upon declaring dividend, company will have to pay DDT. For the receipt of money, individual has to pay the normal tax, treating it as deemed dividend, and both cannot be offset at all. At least now the law seeks to see that this anomaly is addressed. Only the individual concerned need not be paying any tax. Company will pay DDT both for normal dividend as well as for this 220T also. So to that extent, the double taxation could be avoided. But the danger here is, ignorantly sometimes the SEC would draw the money, and we have Supreme Court judgment that the fact that you are subsequently repaid will not reduce the taxability or reduce the rigor of the provision. It will continue to be taxable moment it is drawn. So therefore one has to be little more careful. Of course we have number of judgments to say business transaction related advances would not trigger 222E. Ambassador Travels Limited, Bombay, Delhi High Court, and few other provisions would continue to give, few other judgments would continue to help us to say business related transactions will not get hit under 222E. Now facts only will adduce to what extent it is an advance relating to business compared to the other unrelated party transaction, whether you have arm's length advances or additional advances, all that to be tested to prove whether it is really a business related advance to be away from the ambit of 222E. That's with reference to this corporate dividend tax. The amendment came in the law. One way the setting of provision really helps. I am reminded of one practical scenario where an ignorant SEC was caught because of this provision. This gentleman wanted to acquire land for a company for future benefit. So he has gone, identified the land, paid advance from the company to the landowner. By the time when he was about to register the land, his home ministry, madam, said it has to be purchased in his name only. Though he was originally intending to purchase in the name of the company, because of this home ministry's command, he had no other option except to register it in his personal name. He registered it. When finalization of the account started, they came to see that advance has come from the company, in the books of the company advance given, but land got registered in his name. Now no other go, the advance has to be characterized as advance given to the managing director having the shareholding above the threshold prescribed. Now, somehow during the course of the scrutiny it got picked up. 2 crore rupees received. Officer said, I will not disturb the company, but in the individual status he has received 2 crore, profit is too much. That's a 10-year unit. 10-year unit usually will show more than normal profit, so huge profit was there. 2 crore rupees dividend tax. So he has paid dividend tax. In his personal status, it is added as income. Now the company wanted to see that this debit balance of 2 crore is to be addressed. So what to do? So what they said, 1 crore will declare dividend for his 90% share and another 10% share balance amount. For other person they have given. For him this dividend declared, whatever due, we will adjust that 1 crore. Then only they came to understand for this declaration of 1 crore, again DDT they have to pay. The individual has already paid tax on the 2 crore. Now for declaring this dividend, the company has to pay DDT again. They have paid. 1 crore got adjusted, meanwhile another 20% has gone. Already 30% on 2 crore has gone. Now this 1 crore and another 10% to other shareholder, 110, whatever 20% on that has already gone. So some 22 lakh rupees. Already 2 crore into 30%, 60 lakh has gone. Now 22 lakh rupees has gone for DDT. Balance 1 crore still remains. In the books, another 1 crore remains. Now the managing director said to the auditor, no more dividend route. Think about something else. You want to somehow close the balance, think about some other route. What to do? So now they thought, okay, we'll increase the salary of managing director. At least company will get a deduction. So they increase the salary and set off against the receivable. Now you increase the salary, you have to deduct TDS. Where is the money? We are setting off against the receivable. So money is not available, they have set it off. So for that, company voluntarily paid TDS. We can't recover from the employee concerned. So they voluntarily paid TDS. Whatever TDS on that mode, company voluntarily paid. Fine. TDS department took survey on that. So what it said, you should have deducted the money from the employee concerned. You have voluntarily paid out of the pocket. Therefore, it's a perquisite. You should have grossed it up. You have not grossed it up. Tax on non-monetary perquisite borne by the employer, it is to be treated as income in the hands of the employee. To that extent, you should have grossed up. Again, pay some more money, and for which interest has to be paid. for that one time 2 crore they have taken, include all these costs together with interest, this has come up to 2 lakh rupees, 2 crore rupees. So therefore, 222E is a very dangerous proposition, especially in a closely held company. Therefore, what one has to advise the SSA, of course, the problem here is the emotional content involved. If you have shareholding below 10% and draw money, how much ever you draw, it's not a problem. But you have shareholding above 10%, draw money, how much ever you draw, you are getting caught. So, unfortunately, for other 2 provisions, for ascertaining the 20% limit or this 10% in this case, for other 2 sections out of 8 places in the income tax law, for 2 other provisions, not only the assessee's percentage is relevant, also the spouse percentage is to be counted. For 222E, assessee's percentage alone is relevant. So, if the assessee and spouse are shareholders, assessee has got 8.5% and spouse has got 91.5%. And a person who has got less than 10% is receiving loan. The clubbing of that percentage does not arise in 222E. So, if the assessee would like to draw the money, before drawing money, his percentage should be less than 10. Or the assessee's family members who have got percentage less than 10 should draw the money. If that is addressed, definitely at least from 222E, one can at least try to bail out the case. But unfortunately, all these things possible when the assessee comes and asks us before doing it. 98% of the cases, he will do it and then come and not even say, we only will identify. And another scenario would be, he will say to his accountant and say, go and tell auditor, he will find alternative solution. If we ask first, he will say no. He will do something and then he will find a solution for it. That's the tendency with which the assessee would approach the council, and in all those cases where there is a possibility otherwise, which will be lost. There could be a possibility to overcome, which would be lost, because 222E also talks about the substantial interest. We have 224(4), again talking about substantial interest. We have section 13(3) talking about substantial interest. We have 17(2) talking about substantial interest. We have 48 talking about substantial interest. We have 64 talking about substantial interest. 245C talking about substantial interest. Out of all these cases, for 64 and 13(3) alone, not only the assessee's percentage is relevant, also for 64 spouse to be clubbed, for 13(3) other relative to be clubbed. In all other cases, assessee's percentage alone is relevant. Spouse percentage need not be clubbed. So one can think about this and address the scenario, provided assessee comes before us before doing the transaction. After that it is not possible. This is something one always can plan around, whereby Companies Act 186 could also be addressed appropriately. Otherwise, we'll get caught in more than one act and we will have to face the music accordingly. That's with reference to 222E, we will have to also look into. The next proposition is dealing with 56.2. 56.2, very interesting proposition. 56.2 said originally cash and cash equivalents received by an individual or HUF from anybody other than the specified personalities would be exposed to tax, indirectly bringing the gift tax into the income tax act. Then the provision went further to say not only the cash and cash equivalents, also specified assets, immovable property and 6 movable properties alone would be covered. The recipient being individual HUF. And then government extended the scope further to say a firm or a company receiving the shares of closely held company from anybody at a price less than the fair market value, then provisions of 56.2 will get covered. So, if a share of a closely held company is a subject matter, an individual or HUF firm or company receiving it for a consideration less than its FMV will get exposed. So what happened? Individual, HUF, firm, company. AOP is not covered there. Private trust is not covered there. So people used to create firm AOPs and private trusts and receive shares in the name of such private trust and AOPs from the parties at a price less than its FMV and ensure that 56(2) not getting triggered. Government realized this and they brought amendment to say individual, HUF, firm, company all gets replaced by the word any SEC. Any SEC receiving from any SEC. We come to know about this tax planning only after the amendment comes. Unfortunately, Gujarat is a place where the amendment gets generated and thereafter gets widespread either on the northern side or on the downline side, and by that time we come to know about all these things and planning to do this, amendment comes retrospectively or prospectively. So now private trust for the last 7-8 years they have been doing left, right, center private trust and thereafter these AOP concepts, and by that time we attempt to do it. Now 56(2)(10) comes into law which says any SSE receiving these 10 properties from any SSE will get caught. Now let us take a scenario. Section 47, clause 4, clause 5. A parent giving a capital asset to a subsidiary, whether for adequate consideration or for inadequate consideration, is not a transfer at all, provided the subsidiary happens to be an 100% subsidiary and it continues to be 100% subsidiary for a period of 8 years from the date of the transfer. Now from the payer side, from the person giving, from the company's perspective, which is a giving company, 47 will not get triggered. 47 says 45 will not get triggered. It is not a transfer at all. No need to pay capital gains tax even though you have actually sold. No need to pay capital gains tax. Now let us come to the receiving company. 56(2) says anybody receiving from anybody. Now the parent company has gifted a property to a subsidiary company. 47 will say that transferor is not exposed to capital gains tax, but this recipient company will get exposed to 56(2). This is something which originally it was not intended, but somehow because of 56(2)(10) it came into the statute. Therefore, the Finance Act 2018 says from this provision 47, 4 and 5 got excluded. From the application of 56, 47, 4 and 5 got excluded. So to that extent it spares the provision. Now if it's a share of a closely held company, individual, HUF, firm, company, AOP, private trust, all receiving will get covered. No escape. Now if it's an immovable property, individual, HUF, firm, company, AOP, all will get covered. But 56(2) still has got one important aspect. It says the assessee who is receiving this property should treat this as a capital asset. Only then 56(2) will get triggered. If the assessee receives this as a current asset, then 56(2) would not get triggered. Let us take a practical scenario. A land and building, of course I am restricting myself to discuss this because capital gain is something which Mr. Ramchandran will discuss on the last day. I should not indulge on those aspects. To comparison purpose, I will just pick up this. Because chairman has clearly said on capital gain matters you should not speak. I said agreed. Right? Therefore, I will not go on to any amendment relating to capital gains for the day. Mr. Ramchandran would be handling it in detail. I has mentioned very clearly. For comparison purpose, let us take land and building sold for a consideration which is less than the guideline value. If the person selling happens to be a person holding it as a capital asset, 50C will come. If the person who is selling happens to sell this as a current asset, 43CA will come. If the person purchasing this receives this as a capital asset, 56(2) will come. If the person receiving this receives this as a current asset, 56(2) will not come. So if a person purchases the land and building at a price less than the guideline value, we'll make him as a real estate broker. By the conduct, by attending circumstances and evidences if it is possible, the application of 56(2) could be avoided, depending on the facts of the case. If the amount is so huge, we will make as real estate dealer, nothing wrong on it. So it is up to the assessee to decide. So now the law says, seller current asset 43CA, seller capital asset 50C, buyer capital asset 56(2), buyer current asset no provision to tax it. So even today one can plan about it. More about 50C and 46, 50C, 43C, etc. In another slides we'll take it up. Now, section 276CC talks about prosecution proceedings, wherein it says if the tax payable determined as reduced by advance tax and other prepaid taxes, the gap is going to be 3,000 or less, prosecution will not come, is what the law says. Now, Finance Act 2018 says that 3,000 limit will apply to all assessees other than corporates. For corporates, even if it is less than 3,000, prosecution proceedings can continue. So many shell companies are available in the country where they don't have income at all, they have only capital transactions. Their income and tax thereon will be always less than 3,000. So they will escape from prosecution proceedings. And therefore, the amendment is introduced to say for corporates, this 3,000 limit would not apply. The last corporate related proposition, the last amendment came in is amalgamation related cases, real estate sector. We have just few minutes back, we have picked up this section. 43CA for land or building or both, held by a businessman. 50C, 56(2). What actually is the tolerance level the government comes up with? In all these cases, the guideline value fixed by the registrar and the transaction value executed by the SC. If there is a gap, definitely the provision gets triggered. Now, Finance Act 2018 says if the gap is 5% of the transaction value, fine, the provision need not be triggered. So, your guideline value 1 crore, transaction value 96 lakhs, 4 lakh is not required to be considered as income, either for 50C purpose or for 56(2) purpose. So, 5% tolerance provided. Now, fairly for all the 3 sections they have come up with this 5% tolerance, provided at the first level we are able to say the transaction value, guideline value, the difference is less than 5%. Now, transaction value and guideline value, there is a difference, and you would like to challenge the difference by resorting to DVO method. So, there are 2 ways in which you can challenge. One is the value fixed by the sub-registrar itself is not correct, where you can challenge in the stamp proceeding. Other one, you are not willing to challenge in the stamp proceeding because by and large the seller would be not in a position to challenge. Buyer only will challenge in the stamp proceeding. For some reason buyer is not willing to challenge. He is ready to pay the incremental duty and get the document back. Now it is not challenged. It goes away from challenging. Now come back to the seller. As because the buyer doesn't challenge in the stamp proceeding, should the seller be in trouble? So therefore 50C2 came in, which was copied in 56(2) as well as in 43CA, to say if at all it is not challenged in the stamp proceedings, you can request the AO to refer this property for valuation before the DVO. So now in the Income Tax Act itself, you can ask for a reference to valuation officer. Now guideline value X amount, but the actual transaction value is something less than X. Buyer has not disputed, he paid the incremental duty and he got the document back. Now you are referring to DVO, you are asking for a reference to DVO. Very good number of judgments came to say if at all a reference is asked for, AO is duty bound to do this. Although the section says may, 50C2 says may, number of judgments came in to say that it's a beneficial provision to SC to reduce the hardship and therefore AO is compelled to refer the property for DVO. He cannot say no. So now the reference to DVO takes place. Now 1 crore is the guideline value, 60 lakh is the transaction value. You are asking for a DVO reference. DVO says 65 lakhs. Whether this 5% tolerance could be applied over there. DVO rate is 65, my transaction value is 60. At least 5% can be asked for, it is a question mark. Unfortunately, the section does not give 5% tolerance on the DVO valuation. Only on the stamp duty cases it says. Once the matter goes out of the stamp duty, it goes to DVO vis-a-vis transaction value. This 5% tolerance introduced in the statute from the financial year 18-19 is not going to be applicable. But we have CP Gautam case rendered by Supreme Court in the context of chapter 20C, wherein Supreme Court said valuation is an art, it is not an exact science. You ask two valuer to give a report, you will have two different valuations. Since it is not an exact science, it's only an art, definitely room for adjustment has to be considered. Therefore, if the valuation comes to 65 lakhs and your transaction value is 60 lakh, in chapter 20C, Supreme Court in CP Gautam case said 15% tolerance you can give. When valuation is 65 lakhs and actual transaction value is only 60, 15% tolerance can be considered for the purpose of chapter 20C. For 50C also, Mumbai Tribunal, going by CP Gautam case, said, although there is 15% there, we will give 10%. Up to 10% it is not a problem at all. If the gap is less than 10%, going by the principle enunciated by Supreme Court in CP Gautam case, we will say no addition is warranted. Now, human mind is always ingenious. Now you have 80 lakhs as the value fixed by the departmental valuation officer. 60 lakhs is the transaction value. Now 60 lakhs to 80 lakhs, 20 lakhs is the difference. You apply 10% on 6 lakhs, 6 lakhs gap. But this is beyond. The officer will say 20 lakh is the gap, therefore I will go with 80. Now Asti will say, addition you are going to make for 20 lakh, leave 6 lakh, for 14 lakh only you make addition. Anyway 10% you can give, right? Another ingenious thinking process comes up. At least 5% first you consider. Over and above alone you make addition. If it is over and above, don't make addition for the entire amount. Of course, this is something new thinking emerges before tribunals, and we will have to wait and see how the for and against judgment is going to come. But still, the gap between the DBO valuation and the actual transaction value is 10% or less. We have even today rulings of the tribunal to consider this. 5% tolerance section provides where transaction value and guideline value. Now transaction value and DBO value section doesn't provide anything, but if the gap is going to be 10% or less, even today we have rulings to help us out so that we can still avoid paying tax on that excess so long as the gap is less than 10% threshold. Fine. 43 CA, the section came up with one change originally for 43 CA, then it is brought to 50 CA, then it has been brought to 56 2 as well. Now guideline value 1 crore. Generally moved properties are executed with a time frame. Agreement is entered into, after that you verify all the credentials and then you execute. Guideline value 1 crore. Agreement entered into. I will purchase for 1 crore. 1 crore is market value, I will pay 1 crore. Afterwards, 3 months time for the purpose of execution of the deed. 2 months after the agreement, before the execution, government increases that 1 crore to 1 crore 20 lakh. Now on the date of registration, the guideline value is 1 crore 20 lakh, but the parties have originally agreed to pay only for 1 crore. So the transaction got executed for 1 crore. Now on the date of actual transaction, guideline value 1.2 crore, but actual consideration parted with is only 1 crore. Whether 50C would come for the 20 lakh was the subject matter. When I was really doing the transaction, intending to do the transaction, I was ready to pay for the guideline value. In between, the government has increased the guideline value. Why should I pay to the party more than that? So assessee sticked on to the same number, 1 crore. Government realized this genuine hardship. Therefore, government said, when you enter into agreement on a day and you execute the transaction on a different day, on the date of entering into agreement, you have a guideline value. But there is a variation on the date of actual transaction. We will disregard this. We will stick on to the date on which you have entered into agreement, whatever is the guideline value, provided on the date of the agreement, if either full or part of the consideration is paid, otherwise than by cash. Otherwise our people will date back the agreement to the date on which the guideline value was less. So therefore the government said otherwise than by way of cash if the agreement is introduced. See, sometimes the legislature presumes something which always may not be true. Government believed that always the state governments will keep increasing the guideline value. Assuming for a moment there is a reduction, was the discussion in Bombay. Many people said, how can it be? It cannot be. I said, we will do it. 9th of June 2017, Tamil Nadu state government reduced the guideline value across the board for all the plots in Tamil Nadu by 1/3. Now keep this in mind. 9th of June, there is a reduction by 1/3. 1st of May, somebody entered into agreement for the guideline value. Paid some money by otherwise by cash. Now, 30th of June, he is going to execute the transaction. Meanwhile, market value has come down. Guideline value has come down, but market value is already less. So now he says for market value, I'll pay. Now let us take numbers. 1st of May, 1 crore guideline value, transaction agreed for 60 lakhs. On 30th of June, when the transaction is executed, 66 lakhs was the guideline value, transaction executed for 6 lakhs. 60 lakhs, cap was only 6 lakhs. Now whether we need to consider this 6 lakhs, because of this beneficial provision introduced in the law, you have got an agreement on a day, transaction on a different day, on the agreement date you paid advance, otherwise then by cash. That day what was the guideline value? This guideline value shall be ignored. This guideline value will be considered. Now whether this SC has to take that 1 crore as the guideline value because of this provision, because this second provision which gives the benefit is a mandated provision. Now the beneficial provision turns to be a not beneficial provision. This provision came into the statute to give benefit to SSC. Now that becomes a non-beneficial provision because of the language employed. It's a command to the assessing officer to consider the guideline value on the date of agreement. Now he says, on the date of agreement, whatever is the guideline value, I will consider. But we have Supreme Court judgment, Mahindra and Mahindra Mills Limited. A beneficial provision should be construed liberally. So this is a beneficial provision. By applying this, the SC is worse off. Presume as if this section is not there. 50C2 is, this provision itself is not there. Then the date on which the transaction takes place, whatever is the guideline value, go with that. So to that extent, this provision can be interpreted. Now the word used here is otherwise than by cash. So they make a journal entry in the books. Quite passive. Advance entry by journal entry. So Finance Act 18 changes the language otherwise than by cash into by any mode by way of account pay across the check or draft or ECS. So all these things ingeniously people think, and whereby law gets complicated. The last proposition here would be 54 EC no longer is going to be applicable for any asset other than real estate assets. 54 EC has got a couple of other amendments anyway. As already I promised Rajesh, I am not going to elaborate on this aspect. The next proposition is about conversion of stock in trade into capital asset. We had Supreme Court judgment, Sharin Bhai, where the language of the law was very interestingly elaborated by Supreme Court. To say, the SSC has converted the capital asset into stock in trade. So he has got a capital asset, that capital asset is converted into stock in trade and sells the stock in trade. In that scenario, what will be the taxation? 100 rupees was the capital asset acquisition, and that got market value of that asset got increased to 500. That was converted into stock in trade when the market value was 500. Thereafter, for 520 rupees it is sold. Conversion per se is not amounting to transfer when the act was not amended. 2/47 was not amended. So, conversion was not a transfer, so no capital gains. For business income, fair market value on the date of conversion, 500. Actual sale, 520. For 20 rupees I will pay tax. For 100 to 500 I will not pay tax. Sharin Bhai Kukka case, Supreme Court said yes, perfectly alright. So government came out with amendment of 2/47 and 45(2). 45(2) said conversion of capital asset into stock in trade shall be deemed to be transfer. And on the date of conversion, whatever is the fair market value, that is your consideration for capital gains. That's your cost for business transaction. But interestingly, 45.2 categorically said, though we call the date of conversion as the date of transfer, we will not ask you to pay tax on the day because you may not have money to pay tax. We will postpone the taxation to the year in which the converted stock in trade is subsequently sold. To that extent, the time limit was extended. So we will have to work out the capital gains on the date of conversion, but we will not pay tax thereon. Otherwise, what will happen? We will postpone the conversion, postpone the tax incidence itself to the date of actual sale. We may ignorantly work out indexation till the date of sale. That is not permissible. We have to work out the capital gains in the year of conversion. Keep it ready. But we will not pay tax. We will pay it only in the year in which the stock in trade is ultimately sold. Fine. When the share markets were doing well, people were doing all these things. When the share markets were not doing well, people started thinking opposite. Some of the stocks lying, they are not willing to sell today because definitely they will sell at a loss. But they believed that it will be definitely getting price at a better rate. Therefore, they converted the stock in trade into capital asset. They converted the stock in trade into capital asset. Subsequently, 1 year or 6 months later, they sold that capital asset. Controversy started. 100 rupees was the purchase price. It was converted into stock in trade. It was a purchase price as business asset. When it was converted, whatever is the price at which is there, they converted. And subsequently, they sold as a capital asset. Assuming for a moment 100 acquisition rate, 500 is the ruling rate by which time conversion takes place. 550 that is sold. As he says, 550, 500. For 50 rupees capital gains I will pay. From 100 to 500, similar to 45.2, there is no provision in the business chapter to tax income arising from conversion of stock in trade into capital asset. Tribunals went either way. Some of the tribunals said no, even then, when you have sold at 550 minus 100, you have to tax it. Some tribunals said 100 to 500 business income, 500 to 550 capital gains. To ascertain long term or short term, 500 to 550 that period or 100 to 550 entire period we should consider. If that happens to be long term for indexation, 500 we should get indexation, for 100 we should get indexation. All controversy started. We have special bench judgment also, but still plus and minus takes place. To overcome that, Finance Act 18 says conversion of stock in trade into capital asset is an income under 224. 28, section 28 clause 6A introduced to say conversion of stock in trade into capital asset is a business income. Fair market value on the date of conversion shall be a business income. Prospect from 1480. Now, at the bill stage, they have not thought one aspect. After conversion, you are not selling that capital asset, you are using for your business. At what rate you will claim depreciation then? On what amount you will claim depreciation was not originally there on the bill stage. At the act stage, they have introduced one more amendment, 43 clause 1, explanation 1 capital A. If you have converted the stock in trade into capital asset and use it for own business, the fair market value on the date of conversion on which you have already paid tax, that becomes your actual cost on which you can claim depreciation. If you are not using it for business, then you sell it at a later point, that is eligible for indexation. The period for the subsequent transfer will be from the date of conversion to the date of actual sale. Previous period will not be recorded. The fair market value on the date of conversion will become the cost for the subsequent round of transaction. All that is addressed, but only problem is cash flow. That is not addressed in this particular case. For 45.2 they said in the year in which you sell that asset subsequently is the year in which we will ask you to pay tax. Similar provision is not included for conversion of stock in trade into capital asset. Year of conversion itself you should treat it as business income and you will have to pay tax thereon. You cannot defer the taxation or payment of taxes for that particular amount to the year of actual sale. But 45.2, I am unable to resist my temptation to elaborate, says it will be taxed in the year in which such converted stock in trade is sold or otherwise transferred by him. It should be sold or otherwise transferred, not necessarily sale. Could be any other methodology. By him. That means the person who has actually converted should sell. So if the conversion takes place in one entity, before the sale that entity gets altered, and the sale takes place by another entity, the sale takes place by another entity whereby that entity did not convert, the original capital gain will not get taxed, and the business income will get taxed. Something which one can explore. Yes, sir.
Like in one case, previous slide,
Okay.
one client had a land individually, and the private limited company did the structure.
Sit down, sir, please.
Yeah. Subsequently, the land was transferred because of the other partners were there. Personal land was transferred to the company. Now, the valuation said the building was also has to be included in the value, but the building is already there in the limited company. Depreciation was made. It's all reported. But the valuation officer said I have to include the value of the superstructure. Now, there are 50 CEC credit.
50 seat with reference to the land component will hit, sir.
Yeah, but the building is also included in the
No,
valuation.
they can include for the valuation purpose. That valuation will say for land how much, for building how much. What I am transferring is only a land. The building is already owned by the transferee. He is not paying for it. Although the valuation number contains it. For the land component, what is the value given by the valuer? For the what rate actually have transacted for land component. For that, if there is a gap, 50C would apply. We need not aggregate both land and building for ascertaining 50C. In a business case, the amendment came in is with reference to small vehicles 44 AE. Episode amendments to certain extent to say 44 AE. In the recent past we had amendment in 44 AD, troubling too much. 44 AE no amendment, but now 44 AE received an amendment where it says small vehicle 7,500 per month per vehicle, 12 ton or above, then 100,000 rupees per ton. If 12 ton, 12,000 rupees per month per vehicle. More than that, for each ton, that 1,000 rupees will go. Accordingly, the number will get altered. Certain compensations received were subject matter of dispute, whether it would be regarded as capital receipt or a revenue receipt. We have provisions under 17.2, we have provision under 28, we have provision under 56. Still, and 55 also, amendments are there. Still, courts have taken a view, tribunals have taken a view that certain type of receipts relating to business, relating to employment would not be regarded as a revenue receipt liable to be taxed. It could be treated as capital receipt, no tax need be paid. One chartered accountant firm received revenue for parting with the business of that particular clientele to give it to another firm. And the Delhi High Court said, no need to pay tax, it is a capital receipt. Now 28 2E proposed to be amended to say, in relation to business, for modification or termination of a contract, any compensation received, it's a business income. Salary, we already have got a profit and lieu of salary, there is a provision, 17.2. But Bangalore Tribunal, notwithstanding that they made a slight distinction and said, money received by the ex-director is not liable to be taxed. So now, 56 to 11 comes in. Salary related, contract of employment related modification or termination compensation required to be treated as income from either source. So the Bangalore bench ITAT ruling gets nullified. Similarly, this Kannada Supreme Delhi High Court judgment gets nullified. So ultimately, all these compensations we will have to pay tax. Better we'll factor that and get the compensation. That's what better one can suggest. Otherwise, this litigation will not make much sense. One can have split further as to whether it will come under 17.2 or 56.2. It's purely of academic nature. Anyway, it will come. End of the day, he has to pay tax. Under which section he has to pay is a great question mark. Otherwise, he will have to pay tax. The next is, of course, what's debated during the bill stage. Standard deduction reintroduced, 40,000 rupees or actual salary. Whether pensioner will get benefit or not was a question mark. When board circular said no, pensioner also, clarification came from the board to say pensioner also will get benefit out of it, no doubt. Then 17 to 8 proviso, medical reimbursement of 15,000 rupees they have taken away. So although 40,000 given, 15 gone. So effectively 25. Then transport allowance, although on that day they have not done anything, they said transport allowance will be withdrawn. And 1st of April onwards, 10, 14, 2 rules got amended, transport allowance was withdrawn.
40,000 actual salary received and lower.
Sorry, whichever is lower. Okay. So anyway, max 40,000 one can get. Now for senior citizens, fairly good number of amendments have come. Standard action up to 40,000 we have discussed. Distinction between senior citizen and very senior citizen dispensed with. 60 years, 80 years. That gap gone. 80D limit, 30,000 rupees increased to 50,000, but not because it has so many sublimits, etc. Maximum goes up to 50. So within that sublimit we have to take the sectoral limit and consider. Also for senior citizens where the insurance company does not give mediclaim policy, actual expenditure incurred for their medical treatment could be claimable, but that limit of 30,000 is to be factored. That limit also gets increased 50. Not that independently 50-50, all put together 50 one can consider. Specified ailments 80 DDB, limit increased. Previously for senior citizen 60, super senior citizen 80. Now the distinction is dispensed with, and total 60 or 80 got increased to 100. Then another amendment which is a very welcome provision, interest up to 50,000 rupees 80 TTB, eligible to be deducted from GTA. Money should come from deposit with the post office, cooperative society or a bank. Immediately thereafter, professional forum started discussing the ramification of this one, whether it should be an SB account or an FD account. 80 TTA talked only about SB. 80 TTB talks about deposit. That means SB is not available for senior citizen, because 80 TTA says for senior citizen this section is not applicable. So they have to go to 80 TTB. 80 TTB start with deposit. That means for senior citizen, FD interest will qualify, but SB interest will not qualify. It's a controversy discussed in the professional forum. Deposit with any bank or a cooperative society or a post office in any account. So that means RD interest, FD interest, SB interest will qualify. We need not say only FD alone will qualify, all of them will qualify. Correspondingly for 194A, interest other than interest on securities, senior citizens, the 10,000 limit got extended to 50,000. Up to 50,000, if the bank or post office or cooperative society is going to give interest to senior citizen, they don't need to deduct tax at source. Finance Act 2017 came up with certain cash related amendments. We'll take a prelude before we step further into the impact of this in the subsequent Finance Act. 40A3 limit reduced from 20,000 to 10,000. But the proviso to 40A3 talking about freight, 35,000 up to 35,000 for freight allowed, that was not disturbed. So other payments 10,000, for freight alone 35,000. Fine. And we have been all along saying that 40A3 is for a revenue transaction. If it's for a capital transaction, 40A3 will not apply. So I purchase an asset, a second-hand laptop for 60,000 rupees. Who will purchase second-hand laptop for 60,000? A question mark. For an example I am saying, don't get into the nitty-gritties of it. And I account 60,000 rupees I paid for a laptop, cash. And I claim 60% those days, now 40%, major rate, all the rate pegged down to 40% from current year. Now, 60,000 you paid, therefore I will not allow, not possible, because 40A3 will apply only for a revenue transaction, not for a capital transaction. Some officers were so ingenious to say, this 60,000 you paid in cash, you claimed 60% thereon, 36,000 depreciation, that depreciation I will disallow. Because original entry is cash, Consequently, it comes to P&L. Therefore, the depreciation on asset purchased by cash, I'll disallow. Tribunal said nothing doing. Depreciation is not an expenditure, it's an allowance. Income tax law has got a distinction for every word. Allowance is different, loss is different, deduction is different, expenditure is different. So you can't mix it up. Therefore, depreciation is allowance, it is not an expenditure. Depreciation on an asset acquired by spending cash cannot be disregarded or disallowed. Fine. We have been very vehemently arguing all these things that reached North Block of New Delhi. So amendment came. So what does it say? 43 clause 1, definition of actual cost. There they amended the law to say, second proviso, if payment is made for acquiring an asset to form part of its actual cost, 10,000 rupees above paid in cash, that will not form part of the cost. So it will not form part of the cost. So on which we will not be able to claim depreciation. It will not enter into the block. So we will not be able to claim depreciation. Now you see, the second proviso to 43.1 says 10,000 above 10,000 rupees cash paid to acquire an asset, it will not form part of the cost. For regular 48.3, the proviso said up to 35,000 rupees freight permissible. Correspondingly, under 43.1 second proviso, nothing is mentioned. So, acquire a machinery, for bringing the machinery to the factory, I pay freight, and that freight happens to be more than 10,000, it will not form part of actual cost. Regular freight paid up to 35,000 will qualify, whereas the freight paid for acquiring an asset to bring the asset to the present location and condition, 10,000 limit only will apply. As because 48.3 has got exception, we should not borrow that to the 43.1 also, and we cannot say all the freight up to 35,000 will pay cash. That will land us in trouble. That is something which are unintended but not required to be continued. At least next year they can amend it. We can make the life simple. How one you will be the person to educate the whole of the country, freight for capital asset, don't pay about 10,000. Freight for revenue account, pay up to 35,000. How to educate all these people in the country? At least in the subsequent round we can set things right. But of course, people in the North Block of New Delhi continue to get the sadistic pleasure of amending the law to see that people are getting always under tension. Now that is something where freight on capex 10,000 only, not 35,000. Now it gives us interesting developments because of this particular change in the last year. Now let us say a practical scenario. 1 lakh rupees advance paid, 50,000 rupees cash paid. Prior to this amendment, entire 150 will qualify for actual cost. Assuming 10% is the rate of depreciation allowable for that asset, 15,000 rupees will be the first year depreciation. Assume for a practical moment, for a particular moment, this is the only asset available in the block. Next year the assessee sells this for 140,000. 5,000 rupees will be the profit on sale of asset. Now, in the revised scenario, 1 lakh will be considered as the block. 1 lakh will enter into the block. Balance 50,000 rupees will not enter into the block. Depreciation will be allowed only for that 1 lakh, namely 10,000 rupees he will get. But next year he will sell for 1,40,000. So he will end up in paying profit on sale of asset 50,000. Now what happens? The depreciation lost 5,000 and incremental profit because of profit on sale at 45. Totally 50,000 rupees is what he has lost. The entire cash payment gets hit indirectly. 50,000 he paid in cash. By depreciation he has lost 5,000. If he sells, in the year in which he sells, the incremental profit to the extent of cash not considered, he will be exposed to tax. Is what at the first sight we get to know. So if you pay in cash indirectly that much money, you will indirectly lose from this. But a closer reading.
If it is a land, you will lose in taxation.
That's the point we will come back. We'll come back. A closer reading of the provision gives us very interesting developments. 40A3 starts, an expenditure in respect of which payment is made or to be made. an expenditure in respect of which payment is made or to be made. So that means present tense and future tense. It does not talk about past tense. An expenditure is incurred first for which payment is made at the time of incurrence or subsequently 40A3 gets triggered. Now if advance is paid first, thereafter expenditure is incurred, 40A3 does not apply. Something very wild thinking. Expenditure in respect of which payment is made or to be made is what the language of the law. So if the expenditure is incurred first, payment subsequently made, the section gets attracted. Now expenditure is incurred subsequently, payment is first made, the section doesn't get attracted. We have tribunal judgment to say 40A3 will not apply for advances. 40A3 does not apply for advances. Now we have another interesting development here. Expenditure is incurred on 20th of March. Payment is made on 2nd of April in violation of law. If it is happened in the same financial year, in the year in which the payment is made, the same year you will find a debit in the P&L, therefore you can add to the profit. Now in the very first year you claim the expenditure, but in the second year you make the payment in violation of law. In the second year when you are going to introduce section 40A3, there is no debit to P&L, we have not claimed that. In the first year in which we have actually claimed, there is no violation of law. So how to link this? Therefore 40A3A came into the statute, which says 40A3 will apply in the year in which the expenditure incurred, payment made. 40A3A will apply in a case where expenditure is incurred in 1 year, payment is made in the subsequent year. So therefore, the opening balance of creditors for whom payment is made in the current year in violation of the limit need to be reported by the tax auditor in the tax audit report. 40A3A is also asked in the tax audit report. So current year payment alone, if you examine it, is not sufficient. Payment made in the current year in relation to the opening balance of creditor is also required to be reported. So what 40A3A says, the debit may not be there in the current year, but still in the year in which the payment is made in violation of 40A3, it will be treated as the income of this year, although no claim is made in the current year. Fine. The language used in 40A3 and 3A, expenditure in respect of which payment is made or payment to be made. Payment was made, was not there. Same language is introduced in the second proviso to 43.1 for capital expenditure. If that being the case, for capital asset we pay advance in cash. Still it can form part of the actual cost of the asset, because it is not a payment made subsequent to the acquisition. Payment is made first, thereafter expenditure is incurred, therefore it will form part of the cost of the asset. Now 40A3 has got 40A3A to say where there are two different periods in which event has taken place. In 43.1 there is no provision to track removal of the block in a year in which no payment was made, but subsequent year payment was made for capital asset in violation of 40A3 limit. Lawmakers in their wisdom introduced 40A3A. Correspondingly for capital asset, they have not introduced. So imagine a scenario where we acquire a capital asset, add to the block of asset, subsequent year we make payment in violation of the limit, subsequent year you can't remove it from the block of asset. In the first year you can't say I will not add to the cost of the asset, because that year it is very much forming part of the cost of the asset. Subsequent year to remove it, we will have to only go to block definition, return down value definition 43 class 6 subclass C item B categorically says as reduced by monies payable in respect of assets sold, demolished, discarded, destroyed together with scrap value if any. None of this will come when you pay money in violation of the limit prescribed. So subsequent year withdrawal from the block does not arise. So that is not yet addressed. Definitely, we will loudly speak like this, it will get addressed next year. At least up to today it is not getting addressed. Alright? Third, interesting development. Assuming for a moment, this does not form part of the cost of the asset. The entire amount I am paying only by cash. Not like the example which you have seen, partly cash, partly non-cash. That will not fit into the cost of asset at all, right? It will not go into the actual cost, it will not get into the block at all. So that means it's a capital asset, but not falling into the block of asset. I am not going to claim depreciation at all. When I am not going to claim depreciation, it's a capital asset, not coming under depreciable block. Subsequently, when I sell that asset, I can claim indexation. If I am holding that asset for more than 3 years, I will not claim depreciation, hold it separately with an identification. In the year in which I will sell, it will not lose its cost. It will continue to preserve its cost, and further it will get index also. When we are selling, naturally less than cost only we will sell, so we will end up in getting a loss which could be offset subject to complying the other conditions. And we have been loudly speaking like this, and that's the reason why the amendment has come in the Finance Act 2018. What's the next bullet? Assuming the law talks only about 43, clause 1, explanation 2, talks about business cases. What will happen to a charitable trust acquiring an asset by paying cash? Will it be forming part of an expenditure, or will it be considered as application of income for the purpose of 11(1) small a? Fine, up to 31st March 2008, from 1/4/17 the amendment came in Finance Act 2017. From 1/4/17 up to 31st March 18, no bar. It can be considered as application of income, provided it's a normal application. If that particular charity has got a business undertaking within it, for that business undertaking it acquires an asset, and for that asset it makes payment in cash. That business undertaking profit has to be computed under provisions of chapter 4D. Again 43(1) explanation 2 will apply to the extent of assets acquired by charity for its business undertaking. If the assets are generally acquired for doing charity, it doesn't have a business undertaking within itself, no problem. This is how we have been loudly saying so, and therefore we have amendment by Finance Act 18. Whatever has come under 40A3 or 3A for a business concern will continue to apply to charities while ascertaining the income applied for charitable purpose. For ascertaining the amount of application, 40A3 and 40A3A, whatever we have said, limits will continue. 40A3, 40A3A will continue to apply. Now, it says 40A3 and 40A3A. 43(1) explanation 2 they have not said. So now it triggers an interesting proposition. 40A3 and 40A3A will apply only for revenue transaction. So while ascertaining the revenue component of the application of income, 40A3, 40A3A will apply. To that extent only disallowance should come. When we have a capital expenditure for application of income, can we say similar to 43(1) explanation 2 not reported in this provision and the explanation 3, and therefore it is not required to be very contentious point. To my mind, very contentious point, very aggressive, but still one can always make a distinction. And 40A1A also roped in here. It says 40A1A how it is applicable to a business. Similarly, it will be applicable to a charitable trust. Now, for the purpose of disallowance, it will apply. In a business, supposing tax deducted and not remitted, or tax not deducted, will disallow 30% of that concerned expenditure. Okay, we have disallowed. Subsequent year, the assessor remits the TDS, will claim that 30% of expenditure. Now, for disallowance, they say 40A1A would apply. In the subsequent year, when the assessor makes the TDS payment, for ascertaining the application of income of the subsequent year, can we claim that balance 30% what we have originally disallowed? Is a question mark. In my personal view, it is possible, because 40A1A in its totality is borrowed here. Whatever is contemplated in 40A1A, year of disallowance, year of subsequent allowance, both can be borrowed over here. same logic will apply. But when you have already expended money, because of disallowance tax comes. Subsequent year when you claim, there will be a loss. Because next year you will be paying TDS, but you will not be actually spending money. So there will be a loss because of claiming this. And that loss when you claim, we have very interesting developments today in the CPC calculations. Loss on capital account is not at all allowed. Loss on a revenue deduction they are contemplating. But on a capital, because of capital expenditure, if you show a loss, automatically return will say 0, and that's how you will have to continue. So these things will definitely open up Pandora box. And 40A1A, 40A3, 40A3A has been introduced or rather borrowed for the purpose of ascertaining the application of income under 11.1 as well as for 1023C. 13th proviso is introduced for 1023C to say 40A3, 40A3A, 40A1A would apply as it would apply to business case. 1023C has got 3 classifications. One is in the educational or medical institutions wholly or substantially funded by government. Another one, medical or educational institutions where the gross receipts is less than 1 crore. Third one, not substantially funded by government, gross receipt more than 1 crore. Third category, medical or educational institution or charitable or religious institutions. They are discussed in 1023C, class 4, class 5, class 6, class 6A. Now only for these cases, namely medical institution not substantially funded by government, gross receipt exceeding 1 crore. Educational institution not funded by government, gross receipt exceeding 1 crore. Charitable institution, religious institution. For these cases only 40A3, 40A3A, 40A1A would apply. So if the medical or educational institutions funded by government, substantially or wholly funded by government, or gross receipt less than 1 crore, they are continuing to enjoy their unconditional exemption of their income. For them, this penal provisions need not be, rather not be required to be imposed. Chapter 6A. This one section is an unfortunate section getting every now and then amended. What does it say? It is JJA. Originally they said for corporate employees and thereafter they said it's only for blue collar jobs, etc. We have a series of amendments. 30% of the additional wages paid to the workman, for additional workmen employed during the year, whatever the wages paid, on which 30% will be eligible as additional deduction for 3 consecutive years, is what the section says. But the conditions introduced for claiming this is very, very onerous. The person who has to work with you should be a new workman. He should not be a casual labor. He is a person who should opt for PF. Greatest challenge for the employer. Voluntarily assess is saying, the employee is saying, I'll opt for PF. Central government should not contribute for his PF. That means there are schemes in the country where first 3 years, if the employee doesn't opt, government will give, employer will give. Afterwards, employee can give. And under that scheme, he should not be an employee. He should opt for PF. Payment should be given only other than cash to him. Salary should not exceed 25,000 rupees. And in the current year, he must have worked more than 240 days. Earlier it was 300 days. That means before June 5th, you should have hired him. If you have hired him before June 5th only, then he will be working with you for 300 days. If you hire anybody after June 5th, he is not a new workman. He is not eligible for that year. Next year, if you see, he is not a new workman. He was already there on the first day of the financial year. So he will neither be qualifying current year nor in the next year. So anybody who has got employed in the organization before June 5th, and the number should be such that it should be more than 10% of your previous year-end roll number or 100. So those within first 2 months and 5 days, one has to employ these many people to get this benefit. Otherwise it is not allowable. Was the law. Thank God, government realized these difficulties, that 300 days reduced to 240 days. attrition rate in apparel industry is too much. You can't expect them to continue to work in one organization for 240 days. Therefore, apparel industry alone, the limit got reduced to 150 days. Representation went on to say, not only for apparel industry, also for leather and footwear, that 150 should be allowable. Finance Act 2018 says, we will allow this 150 not only for apparel industry, also for leather and footwear industry. And if current year 240, he was not there, only 220 days is there. This year, he will not qualify. His salary paid in the next year will not qualify because he is not a new workman. This particular difficulty was considered. Finance Act 2018 says, if in the first year he has worked for less than the threshold number, and second year he has worked, from second year, third year, fourth year you claim. So that we will not unnecessarily reduce the intention of the employer to hire people. As because employees in the country are hiring people because of 80 JJAA. That's how the finance memorandum explaining the finance bill says. Even otherwise we want people will hire, otherwise we will not hire. 80 JJAA is only an incidental provision, not only incentive provision because of which we are going to do it. But anyway, two important change brought in, really welcome one. Leather and footwear industry attrition rate is considered, instead of 240 for them 150, and the current year number of days is less, at least next year onwards 3 years one can get benefit. This has received widespread criticism, comment, etc. at the bill stage. 80AC got amended to say, unless return is filed within the due date, deduction shall not be allowed under chapter 6A. But of course we should not stop at chapter 6A, but somehow in the social media they stopped at chapter 6A, and if you do not file the return within due date, 80C will not be available, 80D will not be available. We are the contributors for the next amendment. By saying all these things, even the people in the North Block of New Delhi would not have dreamt. Because of this current year discussion, next year we may get, why chapter 6A part C? Part C will remove entire chapter 6A. We are the contributors for this. We have made enough discussion saying your ATC will not qualify unless you file a return within due date. No assessee worried about it. Only professionals like us. Draconian amendment. How can we file the return within the due date? Very, very difficult. Draconian amendment. 1.5 lakh rupees will not be available. But actually section never thought about all those things at the time it was introduced. Probably next year we may get it. But as of now, it is not there. Previously, section 80AC said 80IA, 80IAB, 80IB, 80IC, 80IE. That's all. Now, by introducing this part C, what other sections are roped in? 80IBA, 80JJAA, 80P, 80QQB, RRB. 5 more sections are contemplated. Handful of people will get benefit because of 80QQB and 80 RRB. We have to really make a study as to how many people in the country will get deduction under that section. Fairly 80 IBA housing project, good number of new cases coming up. 80 JJIA, $1 million question as to how many people are going to really get benefit out of it. 80P, of course, already the section got diluted, good controversy is there. So these 5 sections are added to the list. And in future, if they are going to add one more section in 80A series, they don't need to amend 80AC once again. That gets automatically covered. Government thought, okay, one indirectly reducing the necessity to correspondingly amend, because thinking and correspondingly making amendment is difficult for them. One time we'll amend 80AC. How many new sections we are going to introduce in 80A series? No need to amend 80AC. At least 80AC will take care of this proposition. And the next provision is startup cases, 80IAC cases. Eligible SSE, that eligible business definition code included. Turnover should not exceed 25 crore is the concept. And of course, 3 years consecutively one will get benefit from the date of incorporation. Within first 7 years, they can decide which 3 years they would like to get benefit. And incorporation date originally was supposed to have closed by 2019. They extended it to 21. And of course, definition of that eligible business extended. One particular segment may get benefit out of it. But of course, a welcome amendment. Procedural part. PAN 139A. Section says any assessee other than individual transacting more than 2.5 lakh rupees should necessarily obtain PAN. If it's other than individual means some entity, a company director, partnership partner, LLP partner, AOP member, the concerned partner, member, director also should have PAN. So meaning, otherwise generally for a company there will be a PAN, for a director there will be a PAN, and why should there be an amendment like this? There are a number of cases transaction is carried out in these entities' name, but income doesn't come from them. It's a shell cases where capital transactions are carried out and they don't obtain PAN at all. It continues to go away. So to rope in those cases, this particular proposition, this particular amendment comes into the statute. Nani Falkiwala's quote is always borrowed in all budget speeches. This is not an exceptional area. He said, we must think first and then make amendment, but generally what is happening is we are amending first and then we are thinking. A classic example is this 143 subsection 1 class 6. Last year, 143 subsection 1 intimation process got widened, where the scope of adjustment made by CPC got increased. Class 6 particularly, class 6 went on to say, if your 26A got some income, your form 16 has got some income, your form 16A has got some income, but the CPC finds that income is not included in your return of income, CPC can say this is to be considered. But it is having wide range ramification. Therefore, the section itself for class 6 alone went on to say, when they are going to invoke class 6, they will not suo motu process the return and make an adjustment. For all other cases, arithmetic errors, inconsistencies between the one entry and another entry, incorrect claim, for all those cases, suo motu class 1 to 5 of 143.1, suo motu the return will get processed and intimation will come. For class 6 alone, suo motu they will not complete. They will inform the SSC within 30 days from the date of receiving this information. The SSC says, I am not in agreement with that, and gives a proof for it, it will go ahead. The SSC agrees for it, it will continue. In the month of February or so, the government said it has a wide range of ramification, and therefore they said, we will unofficially give one notice to SSC. The sense we will give the notice, it is not legally backing. Take 30 days to respond. If you do not respond within 30 days, officially under 143 subsection 1 class 6, we will give one notice. It will have another 30 days time for you. Within that 30 days, if you respond, fine. If you do not respond, we will proceed with adjustment. When you are responding, there could be three possibilities. You will dispute fully with evidences. You will agree fully, option 2. You will partly agree, partly dispute. Now you are disagreeing fully, give your reasons, fine. If you are agreeing fully, file a revised XML. We will process and complete. If you are partly agreeing, partly disagreeing, for the part you are disagreeing, give the reasons. For the part you are agreeing, give revised XML. We will complete the job. This is what the scheme which has come up. But your form 16A or 26AS will say gross receipt. That amount will some other amount which does not suffer TDS. The person paying you money might not be liable to deduct tax at source, therefore he did not deduct tax. That amount, this amount put together, you have taken together, and then you have claimed that amount under 44 AD. How the department will link that 26 AS on your gross receipt and income? Really a question mark. Department said, your 26 AS says 70 lakhs. Your income reported is somewhere 11 lakhs. It is not matching. Said this 70 lakhs and some more income, another 20 lakhs, 90 lakhs into 8% is what we are expected to offer. That 8% and this gross amount you start comparing. Where is the question of reconciling? It's a thankless job. Honestly, it's a thankless job. No assessee will pay for it. The earlier fees itself is arrear. And where is the question of making a rectification and reconciliation and then asking for it? And department says your return is not under process. It is kept in abeyance for want of details. Government realized in its wisdom that this is a thankless job. Therefore, this clause 6 will apply for the returns filed for the assessment year 17-18 from 1st of April 17 to 31st March 18. Finance Act 18 says clause 6 will not be there in the statute. Only 1 year from 1/4/17 to 31st March 18, this clause 6 will be there. We have to understand all this literature, giving revised XML, giving a note for disputing, etc. for only this period. This is an area where the national resources are wasted. The entire nation's resource is wasted because of these sort of amendments, experimental amendments. These are all something where at a lower level could be debated and then it should be introduced. National level it is introduced first and thereafter it gets withdrawn. Very long back we have one cartoon where at that time Mr. Sharad Pawar came out of Congress party and went for an election in Maharashtra. Congress did not get absolute majority, Sharad Pawar did not get absolute majority. If they join together, then opposition cannot come to the power. Shiv Sena and other party cannot come to the power if they are able to. Right? Immediately after this fractioned election result, Pawar was asked, will you support Congress? So immediately he said on that day evening of the result, sorry, we will not support. We went to the public against the Congress. Where is the question of support? Next day morning, in the cartoon, it was very nicely depicted. One gentleman opening the paper with a Congress cooler was opening the paper. The first line says, no support to Congress, says Pawar. The newspaper heading, which is reading. And this congressman remarks, that's what the cartoon. Ridiculous. He has withdrawn the support even before giving it. Was the remark of the congressman. These amendments are like that. We amend the law, we attempt to implement it, and we withdraw it. And meanwhile, honest assessees and the councils for that assessees, some nebulous assessees will keep phoning up, etc. We will have to spend hell a lot of time with CPC, and CPC, connecting CPC, getting it done is a nightmare subject. This is one area where government thought we will withdraw, therefore from Finance Act 18 takes away this clause 6 of 143.1. 143.3, scrutiny assessment, of course a new concept is coming up, paperless assessment, jurisdictionless assessment, very interesting time. When CPC itself without paperless, how much of surprises we are getting, we'll wait and see how it is going to take its shape. Last but 1 year or so, 271J came in to say if there is incorrect information in a report or a certificate given by a merchant banker or a valuer or a professional, chartered accountant, an accountant in terms of language of the law, liable for 10,000 rupees penalty. Who can levy penalty? The assessing officer or a CIT appeal. If the CIT appeal during the course of the appeal proceeding finds that an incorrect information is found in the certificate or a report, he can also levy 10,000 rupees penalty is what the law says. Assessing officer levying penalty under 271J is appealable to CIT appeal. Order of the CIT appeal is appealable to tribunal. But the CIT appeal levies penalty first time. Under 271J, with whom we can file an appeal? We can file appeal otherwise only to the tribunal. But there is no provision under 253 enabling that order to be appealed to the tribunal directly. Finance Act 18 addresses the subject. Order of the CIT appeal levying penalty under 271J appealable directly to ITAT. Then 271FA, reportable account, limit penalty number gets increased. 100 becomes 500, 500 becomes 1000. ICDS, we thought because of Delhi High Court judgment gone, retrospectively it has come back. We have to live with that. Of course, branch will introduce another seminar for ICDS once again. At that point, we will discuss that in detail. What these amendments are going to really make life and to what extent it dilutes or it increases the ICDS, independently we will take it up. Then corporate insolvency cases, ROA can be verified by the insolvency professional. Business loss will be allowed to be set off even if 51% is diluted. Section 79 gets diluted. MAT, loss or brought forward depreciation set off. MAT provision for this insolvency corporates, provision gets diluted. With that, from my side, I would like to end.